2020 was a tough year economically. COVID-19 came to the world, as did aggressive lockdowns, and central banks were called to the rescue. They came to the rescue in the form of aggressive interest rate cuts in many cases and rounds of quantitative easing into the bargain. In short, a highly accommodative monetary policy stance in many countries. Now, this provided a welcome relief, there's no doubt about that, in the short term to many businesses and households alike, who often were seriously indebted. But the problem can be what happens in the longer term. These things aren't without consequences. And one of the concerns at the moment is the potential formation of housing bubbles in many countries. Concerns have been expressed in the US, in Canada, and in many countries in Western Europe too. What is a housing bubble? Well, I think the simplest way to explain a housing bubble is where home values in the housing market get way out of kilter with the underlying economic fundamentals at the time. You can have weak economic fundamentals or mediocre at best, and a very strong housing market and very serious increases in home values. How do these bubbles form? Well, often it's started by a very accommodative monetary policy stance, those interest rate cuts. The cost of credit comes down, the cost of mortgage credit too, and aspirant home buyers, because we do have a strong culture of home ownership in many countries, they look at the world and they see cheap credit and they believe that now is the time to buy. So there's a surge in home demand, credit-driven home demand, not necessarily speculative or buy-to-let, just primary residential demand. But that drives the market stronger, and up goes house price growth. What comes next is potentially the problem, where speculators look at the strong house price growth and say, possibly now's the time to make a quick buck. I can climb in cheap credit, using cheap credit, buy properties, sell properties fairly quickly after that, and make quite a big capital gain. With the US mortgage rates at round about 3% and its most recent house price growth in February already at 11.9%, this looks like a significant speculative opportunity. What comes next is possibly the unseasoned buy-to-let buyer. That person who doesn't necessarily understand yields and yields being compressed and the income return, more looking at the recent capital growth and in their mind suffering from recency bias, where they take the recent past, and that's a big influence over their expectations of the future, extrapolating their price growth into the future and believing that it'll continue indefinitely. So they too believe that property is a good investment now because this capital growth will carry on at strong rates and I can make a healthy capital return. So they take the market overshoot even further from where the genuine speculator has taken it. And then comes a third group who take the overshoot even further, called the panic buyers. Aspirant first-time home buyers who weren't necessarily planning to buy just now, maybe at a later stage, but they're looking on in horror as prices escalate at a rapid rate, and they start to panic that if they don't get in now, they will never be able to afford it. Also driven by this recency bias, not understanding that the property market works in cycles. At some point, it becomes too unaffordable and creaks under the burden and then starts to correct. But they see life in straight lines in many cases. So the panic buying takes place. That drives the market overshoot even further. All of this comes with rapid credit growth in many cases too. So the household sector becomes more indebted, often you could call it over-indebted, and therefore highly sensitive to any interest rate hiking at some future stage. And unfortunately, at some future stage, interest rates will go up. That's always the case. So interest rates go up, and very quickly, because of these high levels of debt, there's stress, there's pressure in the household sector as a whole and in the housing market. And because of the sensitivity to interest rate hiking of the household sector, very quickly home demand recedes and home supply increases because there's a whole lot of financially pressured households that need to offload properties because they can't afford them anymore. Oversupplies mount, and with it drops in prices, very significant drops in prices in certain cases. A negative equity situation then forms, and this is the real risk, where mortgage debt owed on a house is now worth more than the homes. And when you've got widespread negative equity, the problem is those households that are under stress can't offload their properties in the normal market and settle all their mortgage debt, that becomes the bank's problem, where the value of security does no longer backs the mortgage loan. And that creates financial stability risk. What typically happens then is mortgage lenders often pull back on their lending, having burnt their fingers. Households pull back on their borrowing. They have to fix their balance sheet. And this then not only poses, the housing bubble as it bursts, not only causes financial stability risk, but it causes heightened recession risk for the economy as well. So you curb the extent of a recession in the short term, but in certain ways, if you're not careful as a central bank, you may just be kicking the can down the road. If you're causing housing bubbles, you might be heightening vulnerability to a recession at a later stage. So you're just moving the problem away. And this at the moment in some of the developed countries, the US, Canada, and some European countries, is a key concern. And it's something that central banks are going to have to watch out for, that they aren't fueling housing bubbles on a large scale, because that can come back to bite and cause the next crisis at a later stage.